Hey, it's Keith. I'm back with a little bit more brown. Thank you very much for communicating with Sarah in my absence and for your patience. I apologize I wasn't able to get the mortgage zone update out last week. It was just a little bit of an overwhelm coming back into hundreds of emails and getting back into gear. So fully on board, starting off this Monday refreshed, and here we go. So, what's going on with interest rates, the debt ceiling, inflation? We're going to break that all down. So what you've been hearing in these, the Signature Bank and SVB Bank, that went under, whenever this happens, the FDIC steps in and they purchase, they take on all this debt. Well, what happens when they do that, they turn it into issue into bonds. And so with supply and demand, when you put more bond supply into the market, without the investors being there, it causes the yields to go higher to attract those investors. So that's one pressure of interest rates moving higher at the moment, right? The opposite side is what's happening with the debt ceiling structure. So we were anticipating good news for a long time as of May 10th. What was the hoped for event? That on May 10th, the consumer price index would come out to show that the core inflation readings were moving lower, which it did. And you can see we had a very good day. Green is interest rates improving or going lower. The following day, producer price index came out, same result. We saw the interest rates continue to pressure lower. This is what we have been anticipating and wanting. However, on the 12th, we had the massive 30 plus trillion debt ceiling budget that was announced. And that now has to be negotiated, that we're waiting for government to come to conclusion and pass. So when you look at the pressure between the Federal Reserve having more surplus of bonds issued to the market to cover that debt of the bank failures, and then also on top of that, the debt ceiling increase, you could see how much pressure that put on interest rates to move higher. So, we were trying to move back into the mid to low sixes. And now we're talking about rates moving in to the mid to high sixes, potentially in some structures into 7% range. So I do feel, again, this is temporary. And what we will see continue is once this debt ceiling is passed, the market tends to normalize. It's just, it's where things get back to, and where the focus is going to go is back on the fact that inflation is moving lower, and that points us more and more into the recession. And we have seen historically during a recession, interest rates pressure lower. Now, one last thing to bring up to date is you're going to hear in media that the Federal Reserve, there was two board members, James Bullard, and I can't remember Logan's first name, but they both came out and said that they want to have a rate hike. Now, keep in mind that the Fed rate hikes increase the short term. So in generalization, that's your credit cards, autos, and student loans that all take that react to those Fed rate hikes. The long term has always oppositely, where it pressures rates lower. So that's the rate hikes show that the Feds are trying to control inflation, and inflation pressure it lower. And then on the opposite side, the long-term side says, well, what happens in US history economics? When the Feds hike too much, we go into recession, that pressures rates lower. So for the long-term forecast, that's why you see the bond market / mortgage rates react oppositely and pressure lower during those rate hikes. So that will most likely come next month in June during the Federal Reserve meeting, which is right about mid to late month. So I'll keep you up to speed on that. If there's any questions that come about, please let me know. But this week, all attention is on Big Gov to figure out how they're going to pass this huge debt ceiling structure. Thank you very much. We'll talk to you soon. Take care.